The following podcast was recorded on Wednesday, June 2nd, 2021, featuring Ben Breitholtz of Arbor Data Science discussing the latest on the housing market. To hear the podcast in real time, you can sign up for a free trial at arborresearch.com or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome to the latest edition of Talking Data. I'm Kristen Radosh of Arbor Research and Trading, joined today by Ben Breitholtz of Arbor Data Science. Today, Ben's going to give us an update and the latest on the housing market. Are we starting to see the beginning of a housing cool down, Ben?
Yes, and I think we are to a certain degree. I'm not exactly expecting any great demise, but what we've kind of seen, bigger picture here is an incredible rise in housing prices. And this is part of the inflation story, but really is going to feed into or dovetail into rents, which we're going to talk about at the tail end of this call. But existing home prices are now on median, somewhere around $342,000. And obviously the highest on record, which is just how things go with inflation, but that's a 19% year-over-year increase. And what we're seeing is consumers all of a sudden in the past number of weeks, maybe a couple months, have gotten apprehensive about these prices. We now have sale prices that are coming in well above listing prices, the actual medians above 100% in that ratio, which is quite surprising. And we're starting to see search activity begin to back off for the process of both, finding homes and also the process of, actually purchasing home, getting a mortgage, closing, and so on.
Let's start first. We've got a chart on the new home demand in comparison to construction.
Yeah, so look at the different construction stages here, and we've seen a pretty dramatic rolling over in actual, new homes that are getting underway and then also completed. Now, the amount of demand that is still there to a certain extent, the degree of not started homes, so those are coming in, putting down their down payment, or not down payment, but putting down some kind of deposit to purchase a home and going through the contract, that's still kind of happening to a certain degree. And you can see that we have a chart here that shows an orange line that remains quite elevated, but those that are under construction and those that are then completed has just fallen off the map. And over the past, maybe month or two, indicative potentially of a slowdown. Now, this is the greatest slowdown in those metrics that we've really seen since 2010, 2011. So if you are judging the housing market by the amount of new home activity, that has appreciably slowed to the degree that we can say that things are cooling off.
And how about the housing inventory?
So housing inventory, and this is something we were just talking about and updating, and this is what's pretty interesting, is the amount of inventory on the market for the first time, that year-over-year change in inventory has finally kind of come off and is starting to rise. Still negative, we're still seeing, somewhere around 37, 38% drop year-over-year in inventory, but that's starting to rebound, which is something that will have an impact on prices if we can get this to really get moving. Maybe, with vaccinations, the reopening of economies, and consumers willing to get out, they are willing to traffic within homes. Would-be sellers are willing to come on the market potentially. This is a trickle right now, certainly not a rush of inventory, but this is a good sign in terms of the health of that market coming back. But that also means that prices may not remain so elevated.
And you mentioned search activity was changing. We've got a chart next on that.
So what we'd like to do is measure kind of three different components here. One, we're looking at home searches, so just those going on Zillow, trying to find a home in their neighborhood or in a certain area. That has dropped and pulled back. It had remained positive on a rolling 1 month basis since the beginning of the year. So this is the first drop in home search activity that we've seen in 2021. Now, the same thing goes for the home buying process. So that's trying to get out and, let's find an agent, let's find an attorney. Let's talk about looking at mortgage calculators. How much can I afford, and so on. That began to drop sooner than the actual home search, which isn't too surprising if consumers are getting, or would-be buyers are getting concerned about prices. they're going to start to pull back on actual activity versus the home search itself. Now, loans and mortgages remain somewhat elevated. Part of that could be refinancing and other things, not necessarily completely tied to the buying process, but bigger picture, the search activity from these would-be buyers has begun to slow. Not disastrous, I want to say that again, but we are seeing a cool down, the first one of 2021.
And you had mentioned in previous podcasts as well that the high prices for homes are starting to become the biggest obstacle. And I think this next chart really illustrates that point.
Yeah, I mean, this is almost scary, just how quickly this changed. I think there was such buying inertia from demographics, millennials, the movement to the suburbs or rural areas, and we've heard all these stories. You look at Boise and many other cities where you have those that were living in these communities upset because these prices have gotten so obscene in certain areas. And this is something that's happening all across the country and many places of the world. But looking at the University of Michigan Consumer Sentiment Survey for buying conditions as it relates to price, this is the worst level we've seen, meaning consumers are the most concerned about these prices really in the history of this data set, like we talked about in the last podcast, which is pretty much my entire lifetime. So this is something that happened quickly all of a sudden, and I think we're starting to see that represented in actual realized housing data.
So how about, you talked about just a moment ago, folks moving out of cities, change the landscape. Really, investors' thirst for real estate is also drying up.
Yeah, that's what is, again, telling another indication of a cooling market. So we saw in terms of ETFs, the amount of money going into real estate, REITs, home builders, things like that, it peaked on a rolling 3-month basis on April 20th of this year. Right around $4.5 billion or so in terms of its actual pace. Now that's decelerated greatly to a pace of around $1.8 billion. Not necessarily a dramatic slowdown, but quite a pullback from what was voracious demand for real estate. Now, REITs are still performing very well and are actually producing pretty, decent returns. But we've seen home builders, in contrast, begun to slow, just like that new home sales data we had shown. They've suffered, a 10+% drawdown from the highs. Well, everything is kind of consolidated here and moved sideways, pretty much any and every asset, I don't care what it is. Home builders has seen a little bit more of a but a little bit more of a pullback than many other assets.
Let's switch next and talk about the rental market. On the flip side, it's really starting to heat up.
Yeah, I think this goes right with the housing story. So if houses are getting expensive, and would-be buyers are apprehensive, they are going to consider the rental market. And I think that is coupled with the reopening of economies and the renewed demand to find apartments and condos and so on, even in urban centers. So the rental market has been heating up. And we've seen evidence of rising rents, and that's something we hear that we'll discuss in the following charts.
Yeah, I think our first chart for the rental parts is on the rental part is U.S. apartment market rebounding.
Yes. So here what we have is an indication. This is a quarterly survey that's done about apartment conditions, and that they're measuring is sales volume and tightness of the actual market. And I have a chart that has those two surveys lagged approximately 12 months relative, and then here we're showing the actual OER, or owner's equivalent rent, on a year-over-year basis, which has been stuck around 2% for the past number of months. But if you can't see the chart and you're listening to the podcast, what is happening is the surveys for sales volume, indicated sales volume, and the tightness of actual apartments has jumped nearly to the highest on record of this survey. And historically, this has led, again, OER, or again, owner's equivalent rent, by approximately 12 months. So this means, according to this, rents will be higher on a year-over-year basis, approximately a year from now. And this is kind of another indication that consumers, or would-be buyers of homes, or maybe even renters themselves, are coming back to the rental market, and that's something that's starting to heat up, and something that will certainly have an impact on inflation. As we've been preaching, we have a lot of transitory forces due to the supply chain woes and issues, and that's something that will continue to percolate for a bit. If you remember, when there's these massive supply chain disruptions that lead to delivery times that are just outsized, right now we're at a multi standard deviation event. You look back at those events since 1950, it typically takes about 10 months for that supply chain problem to correct itself. And that takes us into about November, December of this year. So those will wear off most likely. But what could stay is this rise in rents, a rebound to a more average normal number in rents. And then also wages is another one, but that's a whole nother topic. But if we're able to get back to a 3% year-over-year growth rate, that's going to have a big impact on core inflation, and something that would potentially give rise to that 2.5% plus print, kind of for the long haul, essentially a regime shift higher in core inflation.
We've got a couple more charts we can just run here through quickly that demonstrate OER.
So yeah, OER. Right, so OER here, what we're showing, instead of the year-over-year, let's look at the 3-month annualized growth. And that has started to jump. We're right around 2.8%. So an indication from the actual, OER-based data that is offered by the BLS, indication that that is on the rise. We have another chart, which I think is on the next, that shows that rents themselves are actually rising from other sources too. If you look at Apartment List, or if you look at Zillow's data, the 3-month annualized growth in rents is starting to move very quickly. And even for some of the largest metros, this includes places like San Francisco, LA, Chicago, and so on. And so these really large metros that have maybe 8+ million individuals are rising at about a 45% clip on an analyzed 3-month annualized basis, which is really large. And typically, seasonally, this is when we see rents rise. This is typical, April, May, June. But this time, this wave is considerably stronger than it's been historically. And another sign that yes, rising rents are on the horizon.
So it's not just seasonality that we're experiencing.
No, exactly. And there's a chart here that shows that this wave is a magnitude of 2 times the past. And the other thing too is the search activity from would-be renters has increased and remained quite consistent really throughout 2021, specifically since February. And here what we're able to measure is on a rolling 1-month basis, how many searches within the US are occurring for apartments, 1-bedroom apartments. Are they searching for rent prices or even vacation or short-term rentals? And most of those had remained quite healthy in terms of their rising in nature. There's greater and greater interest, which again is indicative of stronger and stronger rental market. Now we're able to take this data, and we have another chart, I think it's the next one, that then shows what is the probability that owner's equivalent rent on a year-over-year basis will be higher 1 year from now. So we include all this search activity we kind of showed in the previous slide, and then we include the quarterly surveys on sales volume and tightness. And we're able to do then through an ensemble model is say, what's the probability that OER is higher year over year, 1 year from now? And right now that's around 88%. So it's the highest that we've really seen and consistently since 2015, 2016. We have a pretty strong degree of confidence that OER has hit its bottoms and will begin to rise. Now the question is how much. This model here doesn't tell you that. If we were able to get something that was pushing well above 3% year over year, that becomes a much bigger story. That's going to add a significant amount to both core and headline inflation. That's something we'll hope to tackle here as we get a better window or visibility into the pace of actual search activity, as well as realized apartment contract signings and so on, and actual price changes themselves too. So that's something to be determined. But to kind of wrap it up real quick, the housing market is on the slowdown. Now, to what degree? I'm not going to make any big proclamations that this is a major top or we're going to see a significant slowdown. But I think a cooling housing market's important because housing really since 2000 has been the leading of economic indicators. If you look back to 2000, both into kind of the slowdown we saw in 01, 02, the financial crisis, and since, anytime housing has begun to slow, it's been the first to do so. And it's been kind of one of the first to kind of come out of a bottom as well when we've seen some kind of recession or slowdown. So housing is definitely worth watching. Rents are probably the most critical. It seems like individuals are coming back to that market due to high home prices, as well as the reopening of economies. And that's a big inflation story. I think that's more important than all these transitory forces that make all these headlines and everyone gets so excited about. That's due to the supply chain. So as that goes away, keep your eyes on rents, and specifically on models and ideas, kind of like we presented to you today.
Well, thank you, Ben, for your thoughts on the housing market, and thank you everyone for joining us today. For further information on Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.